then I think people are like, okay, I got to get in on this. This thing is only going one way. I've got undervalued stocks with positive momentum and policy support. Why would I, if I were Chinese, why would I not want to participate? And so you see what we've seen in recent weeks, the past couple weeks, where it just gaps up every single day. We're shorts, and a lot of people were shorts. Can't even cover because you just go limit up on individual names day in, day out, which is, as a short, I'm not short, but as a short, not being able to cover shorts is the worst. It ties up your stomach into knots.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunne.
Thanks for the introduction, Niels. Today, I'm delighted to be joined by Louis Gav. We're welcoming Louis back for a second time. He is the founding partner and chief executive officer at Gavekal Research. He's well known in the market as a commentator and economist, and he's been the author of several books. Louis, great to see you again. How are you?
I'm very well, thank you. Thanks so much for having me. I think before we came on, I was thanking you for having me again, and you very kindly said, we'll keep having you on until you get it right. So here I am. I'm back.
Well, I listened back to our conversation last night, and certainly, it wasn't all wrong. No, I mean, there was you were spot on quite a few things. So I think we'll pick up on that a few times. And as you know, we normally get our guests to go through their background, but as you were on last year, we won't do that. But for anybody who doesn't know your background, Louis was on with us last July or so you can go back to listen to that conversation. But I mean, people who do know you obviously would know your firm is based in Hong Kong, and you're very much a firm with a deep heritage of analysing and focusing on the Chinese economy. So it couldn't possibly be better time to have you on. We've had it's the big bazooka according to some people, but not according to others. So I guess the big question is this the turning point for the Chinese economy, do you think?
I think it's definitely the turning point for the Chinese markets. For the Chinese economy, let's not kid ourselves that the Chinese economy doesn't have challenges. It does. You've got real estate prices that are still soft. Even with these measures, they'll likely stay soft. You've had excess construction for a while. And you guys in Ireland know very well that when you go through a real estate bust, it takes a number of years to digest the overconstruction, etc. But markets do anticipate these kinds of things. One of my core beliefs when I invest is very often where there's the most money to be made is when a situation goes from very, very bad to just mediocre. And just in that move from very bad to mediocre, a lot of assets get repriced. And again, I think if you look back at Ireland some 10, 12 years ago, I think you're very familiar with this cycle. So today I think what's fascinating to me is the Chinese government for the past 2 or 3 weeks, every day they come out with something new. Every day they're obviously trying to support the economy, trying to support the market. And the general pushback of everyone I talk to, almost everyone, falls into one of two categories. Either people say, oh, that's too little, too late, it's not going to move the needle. So that's option one. And option two is people say, oh, well, things must be really bad if they're like throwing the kitchen sink in this way. Now, either one of these comments tell me that people haven't been positioned for this. And clearly people haven't been, stocks have rallied by a third in just a couple of weeks. Very few people were positioned for this. Let's not forget that, 2 minutes ago, people were going around saying that China was ABC, with ABC standing for anything but China. Of course, today, one could argue that ABC should stand for all in by China. And that's where we are again, because, and again, here, I think the Ireland example of 10, 12 years ago is super important. A lot of people today look at what China's doing and say, yeah, that fixes this problem, but it doesn't fix all the problems. As if, governments somehow have a magic wand that they can come in and fix all the problems at once. That just doesn't happen. But if you fix at least some of the problems, if you move from a situation that's very bad to a situation that's better, a lot can happen. So, the comparison with Ireland, what was it, in 2012 or 2013, when Draghi came out and said, look, we'll do whatever it takes, and believe me, that will be enough, that made the bottom for the European crisis. And from that point on, European banks started to rally, European stocks started to rally. And today in China, you're basically, the governor of the central bank has come out and said the same thing. Governor Pan came out and said, look, we're going to recap the banks with 2 trillion renminbi. If that's not enough, there's more where that came from, which is a somewhat, frankly, similar statement. And what's fascinating to me is, they chose to recap the big banks. Now, everybody is scratching their head saying, well, why are they recapping the big banks? The problem is in the small regional banks. But the answer is very obvious. They're recapping the big banks for them to absorb all the little banks. And if you absorb all those little banks into the bigger banks, I think you're going a long way into solving the unfolding balance sheet recession that's being unleashed. So again, I'm sorry to ramble on, but again, the magic wand doesn't exist. But if you've moved from a policies that were quite restrictive on the fiscal side, not stimulative enough on the monetary policy side, to all of a sudden easier fiscal, easier monetary policy. And here's perhaps one difference with Ireland in 2012, 2013, is that when Draghi said, we'll do whatever it takes and believe me, it'll be enough, the euro started to go down. We started to go down basically. We'd started to go down already. We'd gone from 150 down to 130, but then we promptly went to 105 against the US dollar. When Draghi said, like, I'm going to sacrifice the value of the currency to reflate the European economy, everybody was like, okay, great. I don't want to be long the euro. What's fascinating to me in the past 3 weeks, and really, for me, that was the signal that this is for real and that this market is going to move fast, is, you had the Fed cut 3 weeks ago and the US dollar fall. And then a few days later, you had the PBOC cut, the People's Bank of China cut, and the renminbi rose. And since China's announced these various stimulus measures, the renminbi has been stronger. And that to me is super, super important, because Chinese policymakers care first and foremost about the value of their currency. They need to. They want to de-dollarize their economy. They can only do so if the renminbi is strong. So as long as when they announce stimulating measures, the renminbi goes up, they're going to keep doing it.
Yeah, I was a bit curious about the rally in the renminbi. I mean, presumably the view is it Chinese capital that is currently overseas will be repatriated, or is there a view that this is strong enough to encourage, foreign investors now to come back into China? Because as you say, ABC China, for a while, it's only 2 weeks ago, a theme was, can we reconstruct the emerging market, the MSCI emerging market index without China, because there was such demand for that type of index. So do you think it's more just Chinese capital coming back, and is that why it's risen today? Presumably it's too early to see foreign capital flowing back in.
I think that's right. Now, obviously the two are not mutually exclusive. You could have both at the same time. But to your point, I think so far it's basically the foreigners haven't had time to buy. Give or take a couple exceptions of guys who run their own hedge funds, who can be quite aggressive, guys like David Tepper, who went on CNBC, pounded the table and said, look, I'm pushing away all my risk controls. I'm just all in on China, which in itself is an important change of narrative, right? Because up until 2 minutes ago, the narrative was that China's uninvestable. It's run by this evil communist party that's going to destroy shareholder value, et cetera, et cetera. So for, one of the best and most famous U.S. investors to go out on TV and pound the table is in itself a proper change of narrative. But yes, you're absolutely right. I think if you think of your pension funds, of your insurance companies, your endowments, up until 2 minutes ago, they were all trying to cut back on their exposure to China, not expand it. And these things are slow moving. They're going to take a while before, you need to have the investment committee. And again, or you look at, the big money management firms, the behemoths of this world, they were all launching emerging markets ex-China funds or Asia ex-China funds. These things take, once you've got the fund set up and you've got the marketing team ready to go, et cetera, it takes a while to ship those rails. So far to answer your question, I think it's been mostly Chinese money. And here, this is perhaps the big difference between China today and Europe in 2012 is today China is running trade surpluses of 80 billion a month, like 80 billion with a B. This is just gargantuan amounts of money. The biggest trade surplus Japan and Germany ever ran was about 40 billion a month at the very peak. So China's trade surplus are twice as large as anything else you would expect. And usually with trade surpluses that large, you would expect, the guy who makes the shoes or the widgets or the cars or whatever China's selling abroad to, take that money home and reinvest it domestically. But because confidence has been so shot because of geopolitical tensions, for a number of reasons, I think the Chinese who could keep their money abroad did so. And so here we are, you look at that 80 billion, I think, has been mostly recycled as much as they could in other assets. But now if all of a sudden the confidence changes and it's like, oh, the government wants the markets to go up. The government is encouraging companies to borrow and buy back their shares when before the government was preventing companies from buying back their shares. It's, easing up on margin loans for individuals. It's like doing everything they can to crank up the market. But then I think people are like, okay, I got to get in on this. This thing is only going one way. I've got undervalued stocks with positive momentum and policy support. Why would I, if I were Chinese, why would I not want to participate? And so you see what we've seen in recent weeks, the past couple of weeks, where it just gaps up every single day, where shorts, and a lot of people wear shorts, can't even cover because you just go limit up on individual names day in, day out, which is, as a short, I'm not short, but as a short, not being able to cover shorts is the worst. It ties up your stomach into knots.
From a market's perspective, things going from really bad to just moderately bad is enough to turn the markets. But there has been some suggestion that we should expect more in terms of fiscal measures. Is that part of your thinking, and is that key to seeing the economy going on a stronger trajectory? Obviously, you talk about the surplus, but the missing piece that for China has always been this, pick up in domestic consumption. Do you see anything down the line or any kind of radical changes there from a fiscal perspective to address that?
So I think, one fascinating development in China today, when you look at consumer confidence in China, and you break it down by people's age groups, so Gen Z, millennials, Gen X, baby boomers, etc., and where people live, you find out that today there's really two groups in China that are deeply unhappy, with very low confidence. Those two groups are older folks who live in rural areas, basically the Gen X and the baby boomers who live in the rural areas. And that's understandable. They're the guys who've been left behind by prosperity, and they live in the sticks, and so nothing great has happened for them. So that group is deeply unhappy. And the other group that's deeply unhappy is the millennials living in first and second tier cities. And here the answer is also pretty obvious. they've been the bag holders on the real estate rollover, right? They're unfortunately the kids who bought real estate at the wrong price and who, real estate is down 20, 30%. So that their balance sheet has been torn to shreds. Now, if you're a Gen Xer, a baby boomer living in first or second tier cities, you bought your real estate a long time ago, you're still way up, so you're fine. If you live in a third or fourth tier city, you're also actually doing fine, because not only has the infrastructure in your town dramatically improved in the past 10, 15 years, you now have high-speed trains that can take you to Shanghai or Beijing or Shenzhen in a couple hours. You have subway systems. All of a sudden, you have a municipal pool. You have subways. Your quality of life has improved dramatically, but you also have better jobs, because the big shift in China over the past 10 years has been the rapid industrialization. Who would have bet 3 years ago that China would be the biggest car exporter in the world? Now, you take a company like BYD. 15 years ago, the average salary at BYD was 11 renminbi an hour. Today, it's 65 renminbi an hour. 15 years ago, BYD had 150,000 workers. Today, it's got 900,000 workers. Now, these workers are typically, they're not in Shanghai or in Beijing. They're in third and fourth tier cities that you and I have never heard of. So if you're in a third or fourth tier cities, you got all these industrial jobs that pay better, you get better infrastructure. So you're actually pretty happy. Again, the guys who are unhappy are older folks in the countryside and younger folks in first and second tier cities. Why am I going into this? Because to your question on stimulus, if you're the government, you think, okay, these are the two groups that basically we need to help out because they've been screwed over in the past 5 to 10 years. So what you do is you do handouts to the guys in the countryside. And this has already been announced. We're going to send checks to the poorest 15% of the population, which basically is the older folks in the rural areas. So that's one. Now, then you get to the question, how do I help the younger folks or the millennials living in the first and second tier cities who got screwed over on the real estate? How do I help those guys? Acknowledging that I don't want to crank up real estate once again, because if I do, then I screw over the Gen Z who then can't afford real estate, who will be unhappy, and they might demonstrate like they did in Hong Kong. So how do I help the guys in the first and second tier cities? So I'm not going to send them a check because they're already amongst the richest in China. So if I send them a check, it's like, would you send a check to yuppies living in Dublin? No, it'll make the people living in Cork and Limerick pretty pissed off. And so what you do is you crank up the stock market. You crank up the stock market and you make it very obvious to these guys. You say, look, you guys actually do have some savings. Put them in the stock market. We'll crank that up and you'll make some money. Now, what's interesting is at the same time, the Chinese government, and that should have been a signal, 2 months ago, came out and said, look, nobody who works in the financial markets will be allowed to get bonuses over $400,000 US dollars. So in essence, it should have been a sign that we're going to crank things up, but we don't want the same thing that happened in the United States, where we organize a bull market to, save the system, and all the bankers pay themselves $5 million bonuses because, they have the good fortune of being on the right at the right seat at the right time, and just get to ride the wave of a bull market, and somehow confuse their own brain and their own activity with the benefits of a bull market. So China, 2 or 3 months ago says, okay, normal bonus is about $400,000. And now what they're doing is they're cranking up the stocks. That's a way to bail out and to make the people in the first and second tier cities happy.
Okay. I mean, going back prior to this stimulus announcement, the Chinese policy seemed to be kind of a grab for a global manufacturing share. And I mean, you talk about this comparison with Ireland or Europe. Like the Irish policy was effectively deflate the economy, restore competitiveness, attract foreign investments, which put a bottom under asset prices. That's fine for a small economy. Now, for a large economy like China, when they deflate the economy, then try and grab international share. Obviously, you talk about BYD, you hear it on the radio here in Ireland all the time, but, Europe has responded with tariffs. So obviously Europe, the US are not happy with this, Chinese overcapacity. So is that sustainable, or are we going to see this being a flashpoint, do you think, going forward?
I think it already is a flashpoint. And to be honest, I think we're a little bit reaping what the US sowed. What happened in 2018 in 2018, the U.S. government said, we're not going to sell semiconductors to China anymore, and nobody's allowed to sell. Semiconductor equipment makers aren't allowed to sell into China anymore. And that really freaked China's policymakers. They thought, okay, they can do it on semiconductors today. Tomorrow they can do it on chemical products or on auto parts, or on industrial robots or whatever else. So we need to be self-sufficient industrially on everything. And you see it very clearly in the data. I can send you a chart if you want. Starting in 2018, the message is given to banks, look, no more lending to real estate. From now on, all the loans have to go to industry. And so you see industrial loans shoot up and real estate loans collapse. And again, we planted that seed where China basically needed to have its own industrial supply chain for everything. Fast forward to today, sort of 5-6 years later, and we wake up with horror to find out that China's entire industrial framework has shifted, where 5 years ago, I think the view was China produces goods that are 70% as good for 70% of the price. So if you want a crappy bicycle, you can buy one in China and it's 100 euros and it'll fall apart in 2 years and then you'll buy another one. And then all of a sudden, we wake up 5 years later to the fact that China is actually producing goods that are at least as good, if not better, than what we're producing in the Western world. And it's still 70% of the price. And from there, to your point, I think there's two kind of response from policymakers. So there's the policymakers that say, I need to protect my industry. This is not on. This is a disaster. So I need to put up tariffs. And this is what the US has done, what Canada's done, what Europe is now doing. And I would say that in so doing, we basically refuse China's deflationary impact. Now, to be very clear, China's been deflationary for the world for the past 40 years. There's nothing new in China's deflationary impact. What is new is we're now saying, you know what, we don't want China's deflationary impact anymore. It was fine when it was on shoes. It was fine when it was on textiles. We don't want it on cars. So we're now going to put up all these tariffs. And then there's the countries that say, whether it's South Africa or in Indonesia or a Chile or a Colombia that says, I'd love to have a cheap car. Thank you very much. I'd love to have cheap industrial robots. And you know what? If you want to fund them as well, for me, so much the better. We're basically China today, when you look at countries like Vietnam, like Indonesia, China is basically allowing other countries to industrialize on the cheap with very cheap machinery and on credit, through very cheap loans. And in so doing, bringing, millions of workers out of the countrysides, out of the rice paddies of Vietnam or Indonesia and into the industrial economy, which is a second deflationary impact, if you want. So, you look at this, there's the countries that refuse China's deflationary impact, mostly Western world, mostly developed markets. And I would say in these countries, you cannot own the bonds because these countries used to absorb China's deflationary impact and are now rejecting it. So they're going to end up with higher structural inflation. And then you have the countries that embrace China's deflationary impact, call them South Africa, call them Colombia, call them Brazil. They embrace China's deflation, call them Mexico, embrace China's deflationary impact. And in those countries, you can own the bonds. So if today you're worried, you're thinking, oh no, China's got all this excess capacity, it's going to be very deflationary for the world. I therefore need to own bonds to cushion myself against this deflationary impact. You have to be very careful as to where you own those bonds. I would argue you don't want to own them in the Western world. You want to own them in emerging markets. I'd much rather own a Brazilian tip offering 6.5% real than a US tip offering 1.7% real at a time when Brazil is embracing trade with China and the US is doing the opposite.
Okay. So the other question in relation to China, obviously, it sounds like bullish on the equity market and presumably yields, bonds will do okay in China. But the big question, I suppose, for international markets is commodities. We've seen copper responding somewhat. It does, I suppose, depend on whether we see a real economy transmission from the measures. So do you think this is bullish for commodities or not? Or, there's been a lot of talk about kind of the tight supplies in some of these markets like commodities, like copper, but it's been kind of very much up and down in a range. Is this a potential catalyst, do you think?
Well, it's definitely not bearish.
Yes. But is it the catalyst, I guess, is the question.
Yeah. It's definitely not bearish. And, the reality today is we have China easing fiscal and monetary policy. And I would argue you also have the U.S. has just eased monetary policy. The ECB has just eased monetary policy. And, it seems pretty likely to me that regardless of who wins between Trump and Kamala Harris, whoever comes in will be easing fiscal policy because that's what new presidents do. They, come in, increase spending, cut taxes. And by the way, both of them are trying to outcompete each other with promises of more spending and promises of more tax cuts. So I think, however you look at it, if you look at the coming year, you've got, okay, I've got easier fiscal and monetary policy in the US, easier fiscal and monetary policy in China, easier monetary policy in Europe. That to me is pretty clear. We're moving into a reflationary world. Throw on top of that a stronger yen, which is typically reflationary for the world, a stronger renminbi, which is reflationary for the world. So all that, should be good for commodities. Having said that, it's interesting to me that, as China has embraced a much easier policy outlook and as Chinese equities have ripped, you're right, copper, iron ore, et cetera, it's bounced, but it hasn't bounced that much. It hasn't. It's been, if 3 weeks ago you thought, okay, game on, China's doing this. You know what? I don't want to own Chinese stocks because for this or that reason, politics, geopolitics, etc. But I'm going to go back to what I always did in the past, which is when China stimulates, I buy BHP and I buy Vale, I buy Rio Tinto and I buy LVMH. You've done fine the past 3 weeks. It's been okay. I mean, but it hasn't been awesome. I mean, you're probably looking over your shoulder and thinking, damn, I should be invested in Chinese stocks. And here's the reality is China is stimulating today, but this isn't going to trigger a new construction boom. It's just not. It took a while before construction really started going again in Ireland, right? Yeah, I mean, you bottomed in 2012, but it wasn't until like 2017 that construction really started to pick up again. And in China, you still have to digest the oversupply that was put on, just as the amount of infrastructure spending that will be done is also not as high. In the past, when China used to slow down, what it would do is go on a huge infrastructure spending bender, build high-speed rails and build subways. And but these are already built. 90% of Chinese people now live within an hour drive of a high-speed rail station. It's like, and that extra 10% is people who live, in the Tibetan plateau or who live out in Xinjiang. It's like, there's no point. There's no economic rationale to link those guys up. And so, you're not going to get a big infrastructure boom. What you're very clearly seeing this time is, again, you've got two parts of the Chinese economy that are hurting: the millennials living in the big cities, the poor people living in the countryside. And we're basically seeing a twin targeted approach to how do we help these guys out. The guys at the bottom, we mail them checks. The guys at the top, we repair their balance sheets through an equity market boom. And so that's what the stimulus is about. I don't think it's about buying a ton more of iron ore and a ton more of copper. No, and again, I think you'll do fine in copper, and I think you'll do fine in iron ore. But it's not where you're going to get the big torque, the big upside this time around.
Okay, I mean, you mentioned a reflationary world, which, if you add all the policy moves we've seen in the last month or so, it certainly looks like that. But I mean, if we went back 2 months to the start, we're recording on the 3rd of October. If you went back to the start of August, I mean, the sentiment was about recession. We had that weak non-farm payrolls, the collapse in the Nikkei, the move down in the US. I mean, we've had this very abrupt change in sentiment. And, if you look at the US, the economic data has been very patchy or inconclusive, I guess you'd say. You had slightly weaker payrolls. Today we've had a strong ISM. Hard to get a read. And then last week, I think gross domestic income numbers revised higher. So kind of painting a better picture for the economy. To your credit, last year when you were on, you were saying no recession. So you got that right. Where do you see things now? It sounds like you're more upbeat on the US and global economy than maybe the consensus.
I'm not downbeat on the US. I think there's more opportunities elsewhere. I think whatever opportunities you have in the US are pretty fully priced into the stock market. When other stock markets are priced in for far more stale outcomes. Now, I don't think you're going to get a bad outcome in the U.S., but it's not where I'd have most of my capital deployed today. In fact, one of the things I ponder is whether, as China rebounds, as emerging markets rebound, because whenever China does better, it always sucks in the other emerging markets as well. Your Indonesia's, your Vietnam's, I think that the source of capital will be the U.S. The anomaly in the world that we live in today is the U.S. is 4% of the global population, it's 20% of global GDP, it's 32% of global profits, and it's 70% of the world MSCI. Can you have 70% of the capital allocated to the U.S. when it's a third of the profits? There's a dislocation there. So the story of the coming years should be money coming out of the U.S. and going into these other markets that are stabilizing and picking up. So, but this doesn't mean you're heading into a U.S. recession by any stretch. It probably doesn't even mean a U.S. bear market. It's just, it's just the U.S. underperforms. You just get less bang for your buck over there. Now, Sorry,
I was going to say, from an economic perspective, we're into it. I suppose we're into it. The reason why you might be bullish in the US market is we're into an easing cycle. Like historically, when the Fed eases, the equity market either does very well or very poorly, depending on if you go into recession. So if you're saying no recession, that would suggest a favorable environment for US stocks. But from an economic,
we are in an unusual period where U.S. economy has been growing at 6-7% nominally, where you've had full employment and where the government has decided to run budget deficits of 7% of GDP, which I think if you go back a year and a half ago when you and I were chatting, that was my main reason why I didn't believe you were getting a recession. It's like, when you look at the weight of government today and you think, the government's running budget deficits of 7% of GDP, you really need the private sector to badly collapse for that to happen. You never want to say it's different this time because you look like a fool, and when it isn't different, people laugh at you. But we have to acknowledge that the condition set is somewhat different. Now, what could easily happen? My core belief, if I look at recent years, U.S. twin deficits have been enormous. Foreigners, the U.S. keeps exporting large amounts of dollars to the rest of the world. Rest of the world actually has too many dollars. In recent years, they didn't know what to do with these dollars. They didn't want to buy U.S. treasuries, which is what they would have done in the past, because you got the debt growing by $1 trillion every 6 months. And instead, I think what a lot of foreigners who earn dollars have done is they've put these dollars in U.S. stocks, and specifically in a handful of stocks. Right. For me, Microsoft, Apple, Amazon, these guys have been receptacles for the excess dollars in the world. And so to the extent saying, and that made sense in a strong dollar world. If you're Chinese, you earn dollars, you see the renminbi fall 5% a year, you see the Microsoft share counts shrink by 3% a year, you see Microsoft cash flow grow 10% a year, you're like, you know what, I'm just going to buy Microsoft. I don't really care about the valuation. Yeah, sure, it's 35 times earnings, but whatever. They're shrinking the share count. It's a very liquid stock. The dollar's going up. And if I change my mind tomorrow, I can sell Microsoft and buy something else. And I think this is the phase where we're now going to be entering, is people say, you know what, US dollar is no longer going up. I don't need to keep as much US dollar assets. And I can let go of my Microsoft now and maybe I buy Tencent. That's a quarter of the value. I buy, in market cap, it's a tenth of the value, but in terms of PEs or whatever else, it's, you're trading at single digit price to cash flows.
Sounds like in the US, you're saying no recession, but not exactly, a boom or not exactly kind of, with the Fed's cutting rates, they say they're on a path to neutral. I mean, what do you think that means in terms of policy? Are rates going down to, I guess, where's our star? Are rates going to 4% or 3% or do they know?
I don't think the Fed knows. But I think they're going to get 50 basis points in November. And then after that, I think it'll depend a lot on the outlook for fiscal policy. To be honest, if President Trump comes in and extends the corporate tax cut, does the tax cuts on for families that he's been talking about, with tax cuts for newborns, and while also massively increasing spending to reindustrialize the United States. And you move from a budget deficit that was planned at roughly $2 trillion for next year, because the tax corporate income tax rate was supposed to sunset, and corporate income tax rate was supposed to go up. If all of a sudden you move from a deficit of $2 trillion to $3 trillion to $4 trillion, then you got an economy that's on fire. And then the ability of the Fed to cut isn't there. Now, on top of that, you've got another big question mark, which is, of course, what oil prices are going to do. Today, for the past year, oil prices have been coming down. They've been coming down for a number of reasons, not least of which the fact that inventories in the U.S. have basically been emptied. The Strategic Petroleum Reserve has basically been emptied. And you look at Cushing, Oklahoma right now, the amount of oil in Cushing is at record lows. So now you would think, well, why are people, cutting their inventories? And by the way, also, you look at the futures market, for the first time ever, you've got a net short position on oil. Why on earth do all this at a time of massive uncertainty in Russia, at a time of massive uncertainty in the Middle East? It does strike me as a dangerous situation. So, could we come into 2025 with, oil prices that have spiked because we didn't position ourselves correctly coming into this Middle Eastern problems, with bigger budget deficits? And if that's the backdrop, it gets pretty hard for the Fed to cut.
Okay, and there's a lot of a lot of easing priced in. And obviously, coupled with that, if we get that scenario that you're talking about, I mean, last year, debt refinancing was a big theme. Less so this year. We've had suggestions that maybe the Treasury has been tactically, issuing more bills because of that, and, particularly with the election in mind. Are you worried about, you mentioned you're more bullish on emerging market debt earlier. I mean, would you have concerns about a fiscal problem in the US or a failed auction type scenarios at some point in the future?
Well, I think you in the past couple of years, each time the U.S. government has tried, almost every time the U.S. government has tried to go to the long end to issue 10 years, 20 years, 30 years, the market has kind of stalled. Now, I think when it comes to debt, it's like tequila shots, right? You never know when you've had enough until you've had too much. And I think, so I look at debt today, I think most people, when they look at government debt, they look at debt to GDP ratios. And, they'd say, when you're above 100%, you get into danger zone. Now, the reality is we've seen lots of countries move above 100% with no problems, including Japan. Yeah, that went all the way to 200%. So that's not to be honest, that's not the right ratio. The right ratio when you look at government debt and when you're looking for fiscal crisis isn't your debt to GDP ratio. The ratio you want to look at is the percentage of your debt that is owned by foreigners. And historically, once you get past 30%, you basically become dependent on the kindness of strangers. And this is when you can sometimes hit the wall. This is what happened to Greece, of course, in 2011, to Spain in 2012, to Argentina in 2000, to Thailand in 97. You move past that 30%, and what happens is one day, there's a bond issue, and nobody shows up because everybody's like, you know what, I have enough Thai debt. In fact, what happens is as soon as things start to go a little wrong, investment committees get together and say, why do we own all this Thai debt? Why do we own all this Greek debt? Just get rid of it. And so there's two major countries today that are above that 30%. One of them is the United States. Now, you could easily argue, and I would take the argument that, in a world in which, all animals are equal, there's some that are more equal than others. And that's clearly the US dollar. US dollar is the world's reserve currency. Whether you're Irish like you, French like me, you need to have US dollars to buy oil. You need to have US dollars to buy copper. So maybe the 30% ratio doesn't apply to the US. But the US is definitely testing that. They're adding $2 trillion a year and probably more. So at some point, you start feeling queasy. The other country that is above 30% is France. And here, it does feel like all of a sudden, investors are starting to feel a little queasy about France. To begin with, you've got an uncertain political situation, a highly, a government that doesn't have the support of parliament. You have you all of a sudden have French, 5-year yields on French debt are now above Greek yields, which has never happened in history. So if you're looking for a fiscal crisis, I think there's two main candidates today. It's France and it's the U.S. And it seems, for a bunch of reasons, probably likely that France will hit the skids before the U.S. does.
Okay. How do you see that playing out if that comes to pass? Obviously, the ECB have the tools in their toolkit in theory, but it has been tested. Do you think it might come to that?
It's a big question mark, right? And I think that's hence the discomfort. But here's what we know is France already massively breached its budget commitments for 2024. All the European countries have had to, were supposed in September to bring their budgets to the European Union. France said, sorry, we couldn't bring ours because we were forming a government. We haven't had time to make the budget. So they got an extra 3 weeks. So right now they're working hard on a budget. The EU is asking France to cut about 50 to 20 billion euros from their budget, which is, very hard to do for a government that has no popular mandate and that doesn't have the support of parliament. Cutting spending is always hard to do, even at the best of time when you have the backing of the population. But today the government does not. So I think what they're going to try to do is raise taxes. But let's face it, France is already the most taxed country in the world. So we're already on the wrong side of the Laffer curve. So they might say, look, we'll increase taxes, but I'm not sure that increases revenues. It might actually decrease revenue. Not only that, but the government may lose the support of parliament. The National Front has already said, if you increase taxes, we're not backing you anymore. So the government's between a rock and a hard place. So how does it play out? Well, what happens, you can get the ECB to help if you've got somebody at the helm asking for the ECB's help. But what if you have no government?
Yeah. I mean, one of the things that strikes me, listen to you, like a big theme that applies both in the US and France and Europe is productivity. And we've seen stronger productivity numbers in the US of late, and a debate there as to what's behind that. Is it seems too early for it to be AI, but maybe not. I mean, some suggestion it's maybe the labor market normalizing after the kind of disruptions during COVID. And then obviously in Europe, you've had this low productivity, and Draghi has been out with his plan and suggestions. Obviously, it's very long term. What's your perspective on those two? Do you think the strength we're seeing in US productivity, is that for real? What's the story behind that? And is there an optimistic case that we might see better productivity in Europe at some point in the future? Or is that just pie in the sky thinking?
No, I think I'm positive on, but look, I tend to have a sunnier disposition. And I also believe that the only wealth is man. And I do think that, in Europe, but also in the United States, you've got, terrific workforces, people willing to work harder, et cetera. Now, when I look at my own country of France, this is actually my biggest frustration. We come up with things like the 35-hour work week, and we prevent people from working more. And when, I think actually you could get France booming again by doing fairly simple things, by saying, look, you work more than 35 hours work will actually de-tax those hours. And which is, by the way, one of the proposal, of course, that Trump has embraced to not tax overpay work. Now, where's the productivity boom coming from in the U.S.? I think here the answer is pretty simple. One of our core beliefs at Gavekal is that economic activity is energy transformed. And if you look at the past 10, 15 years, the U.S. has had one massive comparative advantage. It's been the shale boom. It's been the fact that the price of natural gas has gone from $10 down to $2. The fact that, U.S. has gone from producing 5 million barrels a day to 13.5 million barrels a day. The U.S. basically added one Saudi Arabia in a decade. I mean, it's unheard of. And so that filters through all this added money, filters through into the productivity numbers, which is actually the source of, as a Frenchman, the source of my greatest frustration. Is that if you go back, 15 years ago, 20 years ago, France had a huge comparative advantage relative to the rest of the world. We were, far ahead of everyone in nuclear energy. We were super, super productive on nuclear energy. And basically, to please a small minority of Greens, and why Greens are against nuclear energy is beyond me. If you're worried about carbon in the air, if you're worried about climate change, it's obvious that nuclear energy is a potential solution. But anyway, to please a small minority of Greens, the left wing in France, first François Hollande and then Emmanuel Macron, sacrificed our nuclear stance and our nuclear comparative advantage. Now, they weren't quite as stupid as the Germans, which went just complete full-on stupid and completely shut down the nuclear industry. And in so doing, completely destroyed their productivity, destroyed their industrial base, basically destroyed the very heart of what it is, to be an industrial superpower. Because without energy, without it, you can't have industry. It's just that simple. Without energy, you can't have industry. Now, in France, we're now trying to claw our way back. I think Macron, if there's one silver lining to the Russian invasion of Ukraine, it was that all of a sudden people woke up to the fact that, actually nuclear is actually kind of nice. It's nicer than being dependent on Russian natural gas. And so you've had a big zeitgeist shift on nuclear. So that's, one potential avenue where Europe can sort of snatch victory from the jaws of defeat that the past 20 years of industrial policies, energy policies, geopolitics, immigration policies, you name it, like everything that's been done in the past 20 years that has just been one mistake after another. I think this is where we can start turning it around, is on smarter energy policies.
And do you think, that was one of the kind of suggestions that Draghi was making were, about coordination around defense spending and then kind of cross-border investment in energy infrastructure. So do you think we'll actually get to see those kind of measures coming through in Europe, or will you get the usual policy paralysis?
I hope we'll see it. I fear we won't. And I say this as a Frenchman, I fear we won't. And by the way, when it comes to defense spending, when you look at all the countries who are tech leaders in the world, your Taiwan's, your South Korea's, your US, obviously, Israel, they're all countries that where you have very heavy defense spending because there's an obvious link between defense spending and technology. The internet was an offshoot of a military program. Back when the UK, France had proper armies, and we had, proper big tech companies. We had Alcatel, we had Marconi in the UK. And then we spent 25 years cutting our defense spending because if you're in government and you think, okay, I mustn't have budget deficits and I must reduce my spending, the easiest one to cut is always the army because they don't complain. The military men don't go on strike and they can't. They're not allowed. It's a culture where you follow orders. So you're told, okay, you're going to have fewer planes, you're going to have fewer boats, you're going to have fewer radio equipment or whatever else. And the end result of that is we have no more tech sector in Europe. Sure, there's ASML and there's Infineon and there's STMicro, but let's face it, for as rich an economic zone as the Eurozone is, we really have no tech. And we're pretty much all dependent on US tech. And that's because just as we're dependent on US tech, we're actually increasingly dependent on US military. Now, will this change? Will we say, okay, let's get together, fund some proper military equipment here? Like to be honest, like we did 40 years ago when, as Europeans, we decided to fund Airbus. And I think the answer is there's no appetite for it today because the reality is that ship has sailed and now all countries have to worry about funding their welfare states that are, sort of falling apart. Because demographically they were organized like Ponzi schemes, and now you're getting too many old people, not enough young people, and there you go.
So European challenges to continue. Conscious that just wanted to talk about the election before we finish. You touched on, the likelihood of high deficits in both scenarios. The betting markets have it still more or less 50-50. So presumably it's a coin flip. But I mean, do you see any obvious trades or any obvious differences in the outcomes, that investors should be thinking about, in the kind of immediate aftermath once the outcome is clear?
Yeah, so you're absolutely right that, the polls are 50-50, the betting market is 50-50. But to me, I think Trump's going to win. And the reason I'd say that is if you go back to 2016, if you go back to 2020, and you looked at the polls in the important swing states, the Pennsylvanias, the Michigans, the Wisconsins, the states that the candidates need to win if they're going to win it all. In those swing states, back in 2016 and 2020, Trump was down 7 to 10% every time. And then on the day, he ended up in 2016 winning a bunch of them, and in 2020 losing them, but by very thin margins. Then today, those polls in those states are 50-50. So he's massively outperforming the polls of 4 years ago and 8 years ago. So one of two options: either he's going to win hands down, or the pollsters are now much better than they used to be. But even if the pollsters are much better than they used to be, it seems to, like right now, if you look at those swing states, I think he's winning 5 out of the 7 swing states, according to the pollsters. So I think the advantage has to be towards Trump, and we have to assume that that Trump wins. So if we assume that Trump wins, I think the general perception of a lot of investors I talk to is that if Trump wins, he comes in and he's very brash and he's rude to all the countries, especially China, and that this leads to a further deterioration in the China-U.S. relationship. Now, personally, I'm not sure about that at all. For a very simple reason is when you look at the people around Trump today, they're completely different from the people around Trump last time. Last time around, Trump was surrounded in terms of his foreign policy advisors really by hardcore neoconservatives, guys like Mike Pompeo, John Bolton, Nikki Haley, Mike Pence, for whom, China wasn't as much a competitor as an enemy because it has the wrong it's not a democracy, it's a communist country, etc. Fast forward to today, and Trump is surrounded by Elon Musk, Bobby Kennedy, Tulsi Gabbard, people who are far less abrasive with the rest of the world, far more isolationist, no doubt, and perhaps very mercantilist. But, what's been interesting is on the campaign trail, Trump has been at pains to point out that China is not an enemy, it's a competitor. Now, it's a competitor that doesn't play fair because they've got an undervalued currency, etc. But so all this to say that I think if Trump comes in, you could actually see an improvement in the U.S.-China relationship, partly also because, Trump has been pretty adamant that he wants to find a solution for the Ukraine war. And the reality is, if he wants a solution to the Ukraine war, I think he needs to bring China on board. He needs to say, hey, China, put pressure on Russia to agree to a deal that Ukraine can accept. And, on the back end, this is what I'll do for you. So, I think Trump likes to see himself as a deal maker. He likes, he wrote all these books, The Art of the Deal and whatever else. He wants to sit down with Russia. He wants to sit down with China and come out holding a piece of paper and telling the American public, peace for our days. Here's a deal, and we can move forward. So I actually think Trump is going to get elected, and I think in terms of foreign policy, it could be quite a good thing.
And I mean, you're right, because people forget that he did actually negotiate a trade deal when it was 2019, 2020, just before COVID, and then it was kind of quickly forgotten about. But what about Taiwan then in that scenario? Is Trump more amenable to turning a blind eye to Chinese aggression, or how does that play out? Because presumably a full-on invasion couldn't be tolerated, but that's the stated desire of the Chinese, is to ultimately move on Taiwan.
The stated desire of the Chinese is to have reunification, but that doesn't need to happen through military means. Now, there's no doubt that if you're Trump, I think it's pretty clear you're not going to go to war to defend Taiwan. You have no treaty obligation to do so. And Trump is very adamant. He's a very isolationist guy. He doesn't want to. Now, does that mean that China then moves on to Taiwan? Absolutely not. First, Taiwan is a natural fortress. It's a chain of mountain falling out of the sea. You have only 3 beaches that you can land on. China could destroy Taiwan. You can send a bunch of missiles, you can send nuclear bombs, but what's the point of that? And there's also, you don't have the hatred that you have today in between Russia and the Ukrainians. They're not calling each other Nazis. They're not, preventing the Chinese language from being spoken. There's not, if you look at, the Donbass between 2014 and 2022, you'd had over 10,000 deaths on both sides from, there's none of that in Taiwan. So there's not the black blood. There's no sense of urgency. So there's also this, if you're the Chinese government and you move on Taiwan, the reality is most of Chinese major cities are within reach of Taiwanese missiles. So if you move on Taiwan, you're going to take a heavy casualty count, both economically and in body terms. So it's almost sort of mutually assured destruction. Now, China could definitely obliterate Taiwan and completely destroy it, but it would also take some big casualties. So, there's this equilibrium that isn't going to get disturbed as long as Taiwan doesn't declare independence. And today, you need 2/3 of the Taiwanese parliament to declare independence, and only 1/3 of the parliament is the Democratic Party that is for independence. The other 2/3 are anti-independence. So that's not going to happen for the next, it's a new parliament, so it still has 4.5 years to go. So that's not happening for the next 4.5 years. Or, there's 2 red lines for China. Taiwan is declaring independence and Taiwan saying they're going to have a nuclear weapon. And Taiwan is nowhere near is not doing either of these things. So there's no reason to think that the status quo changes over the next 4.5 years.
And what about the Fed and the dollar? I mean, Trump has been vocal about possible interference with the Fed, and he also, he harks on about, the dollar yen and the dollar yuan rates being misaligned. I know Robert Lighthizer has been an advisor. I haven't heard as much about him of late. I don't know if he's as influential, but he was of that view of normalizing bilateral trade levels on a country-by-country basis. So do you see that as part of the picture in a Trump scenario, more currency tensions? Yeah.
I do. And I think there'll be a lot of pressures put on Japan to revalue, put on China to revalue, perhaps less on Europe because it's not like the euro is massively undervalued. So there'll be a lot of that on South Korea, on all the Asian currencies that are frankly too cheap. But that could be a setup for, a similar situation as we had in the 1980s with the Plaza Accord. If we have a sort of new Plaza Accord, you go back to the Plaza Accord of the mid-80s, commodities ripped, equities ripped. It was like 2.5 years of intense partying until the Germans decided to leave the Plaza Accord, triggering the 1987 crash. But you had 2.5 years of absolute boom. So I highlight this because I think that's no doubt what the a new Trump administration would want to go towards. They're I think Trump is very clear that he wants a weaker dollar. Now, a weaker dollar is very reflationary, very reflationary for commodities, very reflationary for emerging markets. Of course, you could question, well, why would China go along with it? Why would Japan go along with it? And the answer is, the U.S. has a lot of things that can provide China, a lot of incentives to throw China's way. We could say, look, we'll sell you semiconductors once again. We'll stop visiting Taiwan every 6 months. We'll stop, sending high-end weapons to Taiwan. Lots of things China can do, the U.S. can do for China. So the possibility of a big, a new Plaza Accord in which the U.S. dollar is driven down, I think is a distinct possibility if Trump is elected. And if that does happen, then to be honest, I think most people don't have enough risk in their portfolios because all risk assets will absolutely rip high.
Okay. And is that, something that can be managed given what we're already talking about kindness of strangers and the potential, desire to, continue to make the US attractive as a source of capital, as a destination for capital? I mean, if you go into a weak dollar environment, would that naturally put more pressure on U.S. bonds and create a potential issue there, or do you think the two of them can be managed concurrently?
No, I think you'd end up with a much steeper U.S. yield curve. I think long-term yields would end up at 5.5%, 6% pretty quickly. And you'd end up with a pretty steep yield curve.
Good stuff. I know just before we wrap up, last time you were very bullish on EM. It sounds like that case is still there. Is that still stronger than ever? Yes.
Yeah. Now, to be honest, now that China's stimulating, historically the case for EM is EM in my whole career have been either a play on a weaker dollar, which didn't really happen in the past year and a half up until 6 weeks ago, and now all of a sudden the US dollar seems to be weakening, or it's a play on China doing better. And for my whole career, that's been it. You buy EMs when the dollar's weak, and you buy EM when China's reaccelerating. And if you have both at the same time, China reaccelerating and the US dollar rolling over, EM do very, very well. Now, in fairness, I think if you look at the past year and a half, a lot of EMs ex-China have actually done quite well. India's done very well, Indonesia's done very well, Malaysia's done very well. Some of the Latin Americans have struggled a little more, but arguably Brazil is so dirt cheap now, and frankly, so is Chile. So you look across EMs. No, I think that the setup for a lot of them is actually quite enticing.
Good stuff. Well, great to have you back on, and I'm sure we'll have you back on again at some point in the future, just to sense check how all of those forecasts have gone. But no, fascinating to get your insights, so we very much appreciate it. So for all of us here at Top Traders, stay tuned, and we'll be back soon with more content.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.